Hello, I'm Melissa. In today's video I'm going to share our investment strategy for 2022. As you learned in our 2022 financial goal video, we would like to invest $6,000 in my TFSA's account and $5,000 in mine and my husband's RRSP accounts this year. I try and keep our portfolio allocations similar between each account and therefore will use my TFSA account as the example in today's video. I actively manage my TFSA account through Wealthsimple Trade, which is the Canadian broker that we use. If you are new to investing and are looking to get started, you can sign up today and get 2 free stocks using the link in the description below. Our investment strategy allows us to invest for the long term. We like to be aggressive in the right spots but conservative with everything else. Majority of our portfolio will be in conservative holdings. This first chart shows our ideal targets allocation for each category, and the second chart is where our portfolio currently sits. As you can see, we will need to rebalance our portfolio in order to get it back to our target allocation. First, we would like to have about 5% of our portfolio in cash. We would like to increase this to 10% in the future, but since we only started investing a few years ago, we would like to build up our other categories first. We're currently tracking pretty close to our target and will continue to maintain this percentage through the year. Having cash in our account allows us to buy stocks when they are at a great price without having to dip into our savings account. Next, we would like to have about 5% in bonds. When we first started investing, we had this at 10%. However, bonds are pretty weak in terms of return with the interest rates being so low. Therefore, they are not providing enough upside for the portfolio we are trying to put together. Instead of selling the bonds, we are holding onto the ones we currently have and just building up the other categories to get this category down to 5%. The next chunk of our investments will be in ETFs. We want to have about 35% into these. We like the diversification ETFs offer. We can buy one security and that will split up our investment among all the pieces that the ETF invests into. We like to invest into a few different ETFs, one that tracks the S&P 500, the Canadian market, developing and emerging markets and real estate. As you can see, we went pretty heavy in ETFs the last few years, and again we will hold on to the shares we do have and build up the other categories to bring this down. The next section, we would like to put our money into our blue chip stocks. We were keeping this category around 15% last year, but we like to allocate 30% into these this year. Blue chip stocks are your Google, Amazons, Apple, Johnson & Johnsons of the world. They are super large capitalization stocks that are going to remain stable over a long period of time. Blue chip stocks have an excellent reputation and may even pay out a dividend. We like these types of investments as they will still anchor our portfolio, yet will give more upside than just a normal ETF that tracks the market. For example, Home Depot is up about 36% this year alone, which is higher than the VOO ETF that tracks the S&P 500, which is up 23% this year. When looking for these stocks to invest into, we want the company to have a healthy balance sheet and a good management team. Therefore, we do plenty of research before investing. As you can see, we will invest 5% in cash, 5% bonds, 35% in ETFs, and 30% in blue chip stocks for a total of 75%, giving our portfolio a great foundation that is relatively safe and stable for the long term. This leaves us 25% for us to play around with and try for bigger upside plays that can hopefully produce larger returns in the long run. The next section we like to put our money is into growth stocks. Growth stocks are companies expected to grow sales and earnings at a faster rate than the market average but will have more volatility during a market pullback. They tend to trade at a high price-to-earnings ratio, but the valuation could be cheap if the company continues to grow rapidly, which will drive the share price up. For example, Amazon used to be a growth stock. At the time Amazon was starting up, everyone was selling in brick-and-mortar stores. Amazon disrupted the entire e-commerce space and is now a really big company and is considered a blue chip stock. Before we pick growth stocks, we ensure to do a ton of research on the company, as most growth companies have a lot of risk. Since 25% of our portfolio will be in these higher risk plays, we need to ensure that we stay calm when we see volatility. This year we plan to increase this category from 15% to 25%. This sums up our investment strategy for the year. My husband and I did talk about decreasing the amount we invest in growth stocks to start investing into crypto. However, I am not as familiar with crypto and will need to do a bit more research. This might be something we try next year. When forming your portfolio for 2022, it is always a good idea to write it down before you start buying. This way you can go in with a plan to have better success. Thank you so much for watching. If you like this video and would like to see more from me, please subscribe below, hit the like button, and check back next week for more personal finance guidance.